Hi, everybody. This is the investing teacher, high school science teacher, teaching others how to invest. In this video, I want to go over what volatility is, looking at historical volatility and implied volatility, and seeing the difference between a low implied volatility and a high implied volatility, and then compare that in order to figure out the proper premiums that you might be able to receive when you're doing cash secured puts, covered calls, or even the wheel strategy. Let's get right to it. Okay, so implied volatility is essentially the percentage chance that a stock will be within a certain range of values based on what the current share price is. So when you're looking at a stock with zero implied volatility, that would be interesting if that happened, but it's not going to happen. Let's say a stock's at exactly $100 per share, and we expect in the future that the stock will stay exactly at $100 per share. It's not going to move up or down at all. It's perfectly priced into the market. In that case, if you try to sell a cash secured put or sell a covered call at a different strike price, it really wouldn't make much sense because we know the stock will stay at 100 the whole time. So if you sell a cash secured put at 90, not many buyers will want to actually buy that in order to make that work because we know the stock won't go down that price. The stock will be the option will be worth pretty much zero. Now, luckily, there is implied volatility in stocks, and the goal of cash secured puts, covered call, and a lot of option selling is to take advantage of the volatility. Over here, I have a chart of low implied volatility. What that essentially means is whatever the stock price is, let's say the stock price is exactly at 100, we're going to know that the stock in the next year will be within a very close range of that $100. To get a little bit more advanced in the statistics, it's a one standard deviation away that it's going to be within these ranges in 1 year. So if I have an implied volatility of, say, 10%, we know that the price, or we're expecting in the future the price to go between $10 less than 100 or $90 a share, or $10 more at $110 a share. And there's a very good chance, about 68% chance, that the stock will be within 90 to 100 in the year. In this case, many times the the options will not be worth that much in premium because it's within that big range. If we sell a cash secured put down here at, say, 70, there's a very, very low percentage chance that the stock will go from 100 to 70 in a year, let alone if you're selling weeklies or monthly options. So this particular premium will be extremely low, and there might not be many buyers for this particular option. Now, if we look at high implied volatility, we're going to have a much longer and wider range of prices. If the price is at 100 and we have an implied volatility of, say, 50%, then we're saying that there's about a 2 in 3 chance within a year that the stock will be either $50 a share up to $150 a share. In this case, if you sold a cash secured put at, say, 70 right here, you're going to have a decent amount of premium here because there'll be some option buyers that are willing to take the chance that they think it might go much lower than that and then make money on the option, either by exercising it. Let's say that the stock goes down to 50 and we sold the cash secured put at 70. They're going to make a lot of money because they could essentially agree to sell shares at 70, buy them at 50, and they'll be getting $20 per share return. It could also go the other way in covered calls. Let's say you sell a covered call at 110. The premium is going to be very high because there might be some call option buyers that are thinking it could go at least to 110, possibly over to 150. So the premium received if you sell this call will be very high. In general, when you're doing these strategies, you want fairly high implied volatility because the premiums will be more. That also takes into account the percent chance of it actually staying within that range could change a bit. Obviously, if the implied volatility is 50 and I sell a cash secured put at 50, it's going to be a fairly low premium because there's a fairly low chance it might get to that price. So you could fiddle around with low and high implied volatilities and fiddle around with the strike prices in order to get the ideal premium you want for that situation. A few situations you want to look at when you're looking at this implied volatility is based on what percent return you want to expect in the particular option. For instance, if a stock is selling for $100 a share, you would have to put $10,000 up in a cash secured put if you wanted to sell a cash secured put at that price. And let's say you could return $8 in premium or $800, that would be an 8% return for that particular option. And maybe it's a monthly option, so you can make 8% in that month if it doesn't go below that strike price. So again, fiddle around with the percentages and the numbers. If you're more conservative in general, you want to look at lower implied volatility stocks. If you want to be more aggressive, you want to look at higher implied volatility stocks. Also, implied volatility could change in particular stocks during the option. So if they have a stock that's relatively safe that might get earnings coming up, the earnings report will change the implied volatility. One resource that I've been using to find high implied volatility that might receive higher premiums in general is from swaggystocks.com. Swaggy Stocks shows different ticker symbols with very high implied volatility. We're looking at 243%, which is a big range. Now remember, that is for the year. So if you're selling a weekly, it may not necessarily get that low or that high. But this is a good starting point that I look at for possible positions that I might sell cash secure puts on. For instance, yesterday I sold a cash secure put for Mara because the implied volatility was very high. The stock price was about $23.41, and I sold cash secure puts at 18, which is quite a bit lower than what the current price is. That doesn't necessarily mean it's very safe, however, because the implied volatility is very high. If you looked at lower implied volatilities, for instance, BNDX has an implied volatility of 2.87, and the stock price is 58. If I sold a cash secure put at, say, 50 or so, which is quite a bit lower than the price, I'm not going to receive much in premium there because the odds of it going to that low price are very low because the implied volatility is very low as well. So again, that's my first thing that I look for. Look for fairly high implied volatilities. I want some at least 50%, and then I could go up to 1 to 200% if I think it's a possibility. The higher the implied volatility, the further away I typically sell my cash secured puts because I want to get a decent premium with the high implied volatility and also get a pretty good chance of it going worthless, and then you collect the full premium. Okay, one little side note I want to mention. I am a moderator in a Facebook group for the option wheel strategy. And there's a lot of like-minded individuals that will show what they're thinking or actually making in their cash secured puts or covered calls. They're looking for opinions on what might be a good strike price, looking at different implied volatilities, some that might be relatively high that they might make positions on. So if you're interested in hearing more about the trades, I'm very active in the group as well. There's a description down below in this video to join that Facebook group. Again, I'm the investing teacher, high school science teacher, teaching others how to invest. Like, subscribe, smash all that good stuff. Leave any comments down below. I read all comments and will respond to them. Might even make a video out of one of your questions or thoughts. And I'll see you guys next time.